Motors facility in Oshawa, Ontario, is the latest Canadian auto plant to feel the effect of U.S. tariffs.
A major escalation in President Trump's trade war with Mexico and Canada. A new order from the White House effectively doubling tariffs on steel and aluminum imports to a whopping 50%.
Canada has taken a bold step in global trade by securing a groundbreaking $214 billion deal, shifting away from its heavy reliance on the U.S. and making headlines worldwide. For decades, the U.S. was Canada's primary trading partner, accounting for over a third of its exports. But in recent years, Washington's aggressive protectionist stance, especially under Trump's renewed presidency in 2024, brought a wave of tariffs, doubling on key items like steel, aluminum, and automobiles. When U.S. tariffs on Canadian products reached 50%, the impact was felt immediately. Canadian leaders, particularly Prime Minister Mark Carney, publicly announced a shift in direction, declaring that the long-standing trade relationship with the U.S. was effectively over. This sudden break in trust pushed Canadian businesses to seek alternatives. The energy sector, traditionally stable, was also threatened with political rhetoric implying possible future restrictions, alarming investors. As uncertainty rose, Canada accelerated trade partnerships elsewhere, especially in Asia and Latin America. One key milestone was a comprehensive trade deal with Indonesia, eliminating 90% of tariffs and diversifying trade beyond North America. The deal wasn't just about goods. It included cooperation in electronics, mining, and infrastructure, backed by a $2.3 billion Indo-Pacific investment plan by Ottawa. Meanwhile, U.S. industries were hit hard. Automakers warned of soaring costs, steel distributors struggled with doubled prices, and farmers feared retaliatory measures. Business leaders across states voiced concerns, demanding clarity. Yet Washington's strategy continued, even as costs were passed to American consumers. Canada, by contrast, branded itself as a hub of predictability and openness. Slogans like, "We create predictability," weren't just words, they represented a national strategy. Canada expanded deals with the EU, Japan, Australia, and India. As U.S. investment dropped by 28%, Canada saw a 9% rise in foreign direct investment, particularly in green energy, AI, and battery sectors. Global companies started relocating their research centers and production facilities to Canada to avoid uncertainty. This created a boom in Canadian industrial zones, while the U.S. manufacturing sector faced disruptions. Farmers in the U.S., especially citrus and bourbon producers, suffered due to limited access to Canadian markets, which were once dependable. As frustrations grew, some U.S. advisors even joked about annexing Canada to bypass trade hurdles. But the situation was anything but humorous. Canada, meanwhile, focused on building bridges, not walls, reaching out to more global partners. The new $214 billion trade package is now a symbol of this new Canadian strategy, aimed at becoming a global trade hub while the U.S. isolates itself. Experts consider Washington's approach one of the biggest economic missteps of the decade, as it hurts both foreign suppliers and domestic consumers. Trump's tariff escalation has deeply affected auto and energy sectors, making cars more expensive and energy supplies uncertain. American consumers now face high prices at grocery stores and gas stations, while businesses look abroad or to Mexico to shift production. Although even Mexico is now caught in similar tensions. These developments show a clear contrast. While the U.S. tries to shield itself, Canada is integrating more deeply with global markets. Canada's exports grew by 2.6%, outpacing the U.S.'s mere 1% export growth. From automotive parts to pharmaceuticals, Canadian goods are gaining ground. In Europe, Canada positioned itself as the preferred partner, especially with promises of stable rules and transparent deals. Agreements in areas like critical minerals, renewable energy, and tech innovation are reshaping Canada's economy, making it more independent from the U.S. than ever before. This transformation, ironically, was fast-tracked by U.S. tariffs, which forced Canada to diversify rapidly. While some argue that U.S. protectionism might help certain domestic sectors temporarily, the long-term costs of losing allies and markets are undeniable. Global companies value predictability for planning supply chains, R&D investments, and capital flows. Sudden U.S. policy shifts, like overnight tariff hikes on steel or vehicles, undermine that. Canadian companies, increasingly wary of the U.S. market, are now prioritizing deals in Asia and Europe, all while keeping one foot in the American market. According to the World Bank's 2024 report, Canada is embracing globalization just as the U.S. is pulling back. The world is watching closely to see how this trade war will affect inflation, supply chains, and international cooperation. Early signs suggest Canada is emerging stronger, not just surviving but thriving in a fractured trade environment. Let us know your thoughts in the comments, and don't forget to subscribe and turn on notifications to stay updated with our latest videos.